Hello, everyone, and welcome to Create Your Legacy Smart Giving, the third seminar in our popular Legacy Giving series. I'm your host, Mahsa Afgahi, Managing Director, Investment Banking at TD Securities, and I'm also on the Audit and Finance Committee at St. Michael's Foundation. I'd like to begin with a land acknowledgement. As we gather today to connect for the work of St. Michael's Foundation, we acknowledge this land, the people, and all other beings, animate and inanimate, today as well as the ancestors. This area has been a place of communities coming together for well over 15,000 years. This land has been the territory of the Huron-Wendat and Petun nations, the Seneca, and most recently, the Mississaugas of the Credit First Nation. The territory was the subject of the Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, the meeting place of Toronto is still home to many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in community. We are also mindful of broken covenants and the need to strive to make right with all our relations, sharing stories and telling the truth of this place. Miigwech. Here are a few housekeeping notes before we begin today's event. You'll find a Q&A chat box on your screen. Throughout the duration of our session today, if you think of a question for the speakers, just type it into the chat box. We'll hold all questions for the Q&A at the end of our event, and we'll pose as many questions as we can to the speakers. This is a public event, and all questions submitted will be visible to all our guests and attendees. If you're experiencing any technical difficulties, click the Tech Support FAQ or Tech Support chat at the bottom of your screen, and one of our techs will help you. After the event, you will be sent a few survey questions. We would be very grateful if you could submit your answers. I know you're as eager to hear from our guests as I am. We'll be recording today's event, and we'll send you a link so you can listen to it again or share with friends, family, and colleagues. I'd like to introduce our moderator, Barb Polk. Barb is a longtime St. Michael's Foundation donor and vice chair of our Human Care campaign. She retired as president of TD Asset Management in 2010 following a 30-year career in institutional sales and investment management. She now serves on the boards of Crombie Reed and First National Financial. Please join me in welcoming Barb.
Thank you, Masha. Today, we're talking about strategic philanthropy to best support causes that are most important to you. It's no secret that St. Mike's Hospital is important to me. That began 11 years ago when doctors at St. Mike's told my brother that he urgently needed a kidney transplant. Thankfully, I was a match, so I could donate a kidney to him. He's alive today thanks to the operation at St. Mike's Kidney and Transplant Care Center. It's no wonder. St. Mike's has one of the highest kidney transplant success rates in North America. That experience inspired my husband and me to support St. Mike's Foundation. In the years since then, what we've learned about St. Mike's and Providence Healthcare has only strengthened our commitment. They're world-class teaching hospitals and centers of groundbreaking research. They're also on the forefront of digital innovation in healthcare. Here's just one example. St. Mike's has developed an early warning system that uses AI to alert doctors in seconds if a patient needs to be transferred to the ICU. It's reduced deaths by 20%, and it's being commercialized for use in hospitals everywhere. Here's something else we're very excited about. Our hospitals have just launched Human Care. It's unprecedented in both scale and scope. Human Care is not just a campaign, it's a movement to reinvent Canada's patient experience. Now, most Canadians are happy with their technical quality of the medical care that they receive, but for years they've been less satisfied with their patient experience. The long wait times, a disjointed system, bad food, confusing communication, or even worse, no communication at all. Human Care is not just about delivering the best care, but delivering it when, where, and how the patients need it. It's about harnessing research to customize treatment to each patient and about preventing disease in the first place. It's about using big data and AI to treat patients sooner and more precisely. And it's about switching up medical education where the patients become the teachers. And of course, it's about applying a health equity lens to everything we do. I'm excited to be a part of this ambitious $1 billion campaign. And I can assure you, we will be strategic with every donor dollar to support our highest priorities. And we know you want to be smart with your donor dollars to support your highest priorities. Our panelists are now going to show you how to do just that. So let's get started. Denise Batac is a chartered professional accountant who helps clients with tax and estate planning as a partner in Crowe Soberman's tax group. She advises individuals and private companies on how to maximize their philanthropic impact. Lori Duffy brings legal know-how to smart giving. She's a senior trusts and estates advisor for McCarthy Tetrault's tax group and advises clients on how to transfer their assets effectively through trusts and wills. And finally, Mike Flux is a strategic philanthropy pro. As an executive vice president and portfolio manager at Connor Clark and Lunn Private Capital, he helps clients make donor gifts stretch farther. Mike is also a committed philanthropist who supports numerous charitable groups across the city. We're lucky to have him at the St. Michael's Foundation. We're fortunate to have such a great lineup of experts who will answer questions that you type into the chat box. We'll get to your questions in the Q&A. So now, without further ado, please join me in welcoming Denise, Lori, and Mike. So let's start off with a pretty basic question for each of you to answer. What is strategic philanthropy? Lori, can you go first?
Thanks, Barb. Let me start off by providing examples of what isn't strategic philanthropy. The first example that was more common pre-COVID, but it's now coming back. You're about to sit down to dinner and your doorbell rings. It's your neighbor, and they're dutifully collecting for a charity that they are aligned with and that is usually important to them. The Lung Association, because a family member has died from a lung disease, cancer, MS, all good causes, but you've really not thought much about that cause. But you, like your neighbor, you don't want to seem uncharitable and you want to get back to your dinner. So you agree to donate. What amount is the next issue? Well, you look through the last couple of donations that your neighbors have made, and you sure don't want to give less than them. So suddenly you're donating a couple of $100. You take the little receipt, you leave it with the stack of mail and flyers on your hall table, and you finish your dinner. Odds are you never think about that donation again, and that tiny slip never makes it to your tax return. Although it was philanthropic, it was not a strategic or a planned gift, and it wasn't personal to you. My next example is United Way Week at your office. You know it's coming. You know that your office or business has set goals. And this time, unlike the knock at the door, you're going to think a little bit more about the amount and the cause. It's likely a one-time gift, but it is more than you would give at your door. This is getting us closer to what is strategic philanthropy. You're actually selecting a cause and you are considering how to give the gift so it is most effective, and you are factoring in the tax benefits to you of that gift when you determine the size. So true, in my view, true strategic philanthropy is when you sit down knowing that you want to make a difference and you do two things. One, you have a connection or interest in that charitable cause. And two, you want to make a gift to this cause and you want to structure it so that it will be a meaningful gift, no matter what size it is. You want as much of your funds to go to the charity and not go to CRA. You will feel that what you are doing is going to help in making an actual difference. With strategic philanthropy, you usually seek advice. It could be your accountant or it could be your lawyer, but I usually suggest that you reach out to the charity that you want to benefit as they likely have people on staff to assist you in determining where your gift can do the most good and how to structure it so you can give more by offsetting the tax benefits you may receive. I know that St. Mike's has people who are great at this, and they assist our donors in making a strategic gift frequently. So to me, strategic philanthropy is a planned gift for both you, for the tax benefits, and for the good feeling that you get, and for the charity that is important to you.
That's great, Lori.
Do you have any ideas?
Yeah, I got a few ideas. You started with what it isn't, so I'll start with what it is and share some of my thoughts. But strategic philanthropy is really an approach to philanthropy that's designed to fit the giver's overall mission, goals, and values. So it's really about you, the donor, and rationalizing the best way to create a social impact. Really the best way to start is to create a carefully articulated strategy to decide on a goal that matters to you and figure out what it is to take, what it's going to take to craft a unique philanthropic contribution. In simple terms, it's all about you and what you want to accomplish and getting the most out of your gift in terms of the impact you can have, not just in terms of the qualitative impact, but it's also about the quantitative impact. What it isn't, you talked a little bit about what it isn't, Lori. I find what it isn't is just putting a gift on a credit card, getting your air miles, feeling good about that. There is a certain amount of dollars that are going to good work, but for the same amount of dollars, you can get a lot more bang for the buck. And I think that's what our committee at St. Mike's Hospital Foundation tries to do, is sitting down with donors and helping them to understand greater ways to maximize the impact that they can have and help their dollars to go a little bit further. For the same amount of dollars, maximize the impact that you can have. Denise, any further comments?
I absolutely agree. I think the difference between your regular philanthropic plans and strategic giving is exactly that. It's strategic. You're thinking of what's meaningful to you, what's meeting your objectives. If you're philanthropically inclined, it's really figuring out how you are going to achieve your philanthropic plans in the most tax efficient means possible. And just echoing what Lori and Mike both said, it's being able to provide more of a donation, provide more of a legacy, support more of the cause that you want to support in a more efficient manner, and making sure that you're doing that all within your goals and objectives.
Great. Thanks, everybody. Denise, in your work with clients and their financial portfolios, what do you look for when determining the possible strategies to incorporate philanthropy into your clients' plans?
I think we've already kind of echoed it a little bit here, but I think the first place we start at is our clients' plans. What are your objectives? What are your needs? What are your philanthropic plans ultimately at the end of the day? Wouldn't necessarily say there's specific characteristics that stands out. I think we all have philanthropic needs and objectives. And it's just a matter of having that discussion, as an advisor, as a tax advisor, sitting down with each of our clients and saying, what are your philanthropic plans and how do we best achieve that? Looking at your objectives and your goals. So, it's constantly having that communication open with your advisors, making sure you're letting them know of your philanthropic plans. Obviously, it's also about looking at your particular situation. So, once we know a client's particular philanthropic plans, all of a sudden now when they tell us there's a specific liquidity event that's going to occur, some sort of tax event that's going to occur in your life, we're aiming to make sure that those strategic donations that are being made, timely, because we all know that the time in which you make the donation really impacts, offsetting the taxes that would otherwise occur in that liquidity event. So, donations can be carried forward 5 years, but they can't necessarily be carried back. It's important to make sure we're up to date on significant tax events to ensure the timing of donations are made either in the same year or before the taxable event to allow flexibility in determining when we're going to strategically get the tax benefits associated with the strategic giving. So it's funny, but often we get new clients coming to us and saying, okay, I had this huge taxable event last year. I sold my business and whatnot. So what can we do to minimize taxes? the answer is often that there isn't much that can be done if the event has already occurred. So that's why it's always important to keep constantly keeping each other updated about both philanthropic intentions and your philanthropic and specific situations that arise. In terms of, otherwise, it's also keeping in contact with our clients' investment advisors. So if I know a client that has large appreciated gains in a stock, it's in a non-registered account, it's about talking to them about whether there's an intention to sell that stock, and maybe potentially, instead of selling the stock, making a donation in the same year, so that the client can not only give the stock and get obviously the tax benefit from the donation of gifting the stock, but not pay tax on the appreciated gains. And if it's a corporation, they obviously get the added bonus of adding that to their capital dividend account and being able to extract more tax-free funds from the corporation. So quite simply, there isn't really a cookie cutter situation. I think it's all about, we as practitioners really looking for knowing our clients, their objectives, and making sure you have that, communication open and honest about what your philanthropic needs are.
Thank you. Lori, what's your practical advice for the audience who wants to donate to charity, leaving a lasting legacy, but maybe don't have the same kind of a paycheck as maybe Bill Gates or Elon Musk?
Thanks very much. I don't know too many who can do what the Gates Foundation can do, but I do know that their structure is an excellent example of what strategic philanthropy is all about. They have a structured foundation, they have goals, they have people to assist them in achieving and identifying those goals. So we can certainly all do it, but perhaps on a smaller level. So my first suggestion to clients when they come in and they ask whether or not they can set up a family foundation or how they can achieve their charitable goals, and we identify what those goals are and the time frame for them, we determine what that goal is. What do they actually want to achieve, and what is their time frame? Is it to be a one-time gift, a gift to be made immediately? Is it to be made in a number of tranches? Or is it a gift to be made solely on the death of that individual, or in the death of the last of that individual and their spouse to die? Do they want their family members involved? I sometimes find this, particularly with some of our high net worth clients, they want to instill charitable giving and philanthropy in the next generation. And so they will often use their planned giving vehicle to involve family members, to get them all at the table to see what each of their priorities are and how they can achieve that. And so we usually ask at that point, when we're trying to determine what those goals are, do you want the family involved? Do you want this to go on for generations, or is this just a one-time thing? The next thing that we do is we look at the assets that the individual has and determine which are the best ones to use to achieve that gifting goal. Is it the RRSP? Is it the RRIF? Is it securities? And also we look at the timing. Is it to be a staged gift, as I mentioned, or is it going to coincide with a taxable event in their life? So as Denise mentioned, if there is a major liquidity event, are they going to be selling their business? While they're negotiating that agreement of purchase and sale, we always raise with them the idea of whether they want to have a charitable component in it. Because as Denise mentioned, if you do it after the event, you're not likely going to achieve the same tax benefits. So it should be, when you think liquidity event, or you think even of the sale of your cottage, you might think about, is this the time that I can offset some of those gains with the tax receipt and achieve my charitable goals? We may speak about this a little bit later, and I think Mike will probably focus on it a bit, but there are very different ways to set up a fund, not unlike the Gates Foundation, where you can make a donation as frequently, one time only, many times, annually, and then they'll run the fund for you. And I think Mike will talk about donor advised funds in a little bit more detail. And then you can decide annually the amount of your gift and where you want to direct it. And again, coming back to including family members, this can be the one time a year maybe when everybody gets together around the dining room table and says, each of you, child number one, child number two, what are you interested in? What do you want to achieve with this additional wealth that we happen to have in this fund? let's talk about why that's an important charity to you. And let's figure out how we can actually make a real change. Again, going back to my, $50 at the door kind of thing. If you're planning this gift and you have this fund and you've got the dining room conversation going on, it can become very impactful and very meaningful to everybody at that table. And that's a very good result. So, and again, I would suggest that you speak with the charity or send each family member out. I know I have one family that meets annually. Each of the children puts together a presentation for why their charity should get the funds that year. And they go and visit the charity. They see what the work the charity is doing, and they're seeing how their money can best assist in that charity achieving its goals. So become knowledgeable, become creative about your giving. And again, reach out to the charity staff. They've usually got a lot of very good ideas and can direct you to where the money can be used. And reach out to someone like Denise, your accountant, or your lawyer to make sure that the structure is going to work, so that it's going to be meaningful, you're going to get the tax benefit, and maybe get the family together at the same time.
Thank you. Mike, I've heard that it actually can be quite complicated and even expensive to set up a foundation, and that it's really only practical for the very wealthy Canadians. Can you tell us how you have helped your clients to set up a family foundation? What's the minimum amount of money required to start a family foundation? And how can family foundations may be used to make strategic donations?
Thanks, Barb. It's a very important question, and Lori touched on how you can tie a family in to the strategic plan of the family. And I think one of the best ways to do that is through a family foundation. But you're right, setting up a private foundation can be a bit complicated. It can be a bit expensive, and ongoing costs and hassle factors aren't appealing to many families. But having said that, it's hard to quantify, but if you have 5 million plus that you can donate to a foundation, maybe the ongoing costs and the hassle factor can make a lot of sense. And maybe it's even a lower amount for certain families. But what if you're just a regular Joe and you've, a regular high net worth Joe, say, that has $1 million plus or whatever it is? What do you do then? Well, you can't set up a family foundation. It's just very cost prohibitive. So there's something out there called donor advised funds, and you can set them up for as little as $25,000 or even less in some scenarios. There's many ways that you can set up a donor advised fund. Essentially what you're doing there is you're not setting up your own foundation. You're piggybacking on another established foundation, and you're becoming part of that. You're creating a sub account for yourself. You can still name your family foundation under that umbrella. You get separate reporting. It's very similar to having your own foundation. You just don't have all the ongoing administration and expenses of setting up the foundation. It's free to set up. But there's ongoing administration fees that you pay to that outfit. And you can access that through many investment firms, including Connor Clark and Lunn, my firm. Most banks have donor advised fund programs, community foundations, and there's a lot of private providers as well of donor advised funds out there that you can access. And it's really a simple one-page form. You fill out a one-page form, and a few days later, or the next day, you have a family foundation set up. Then the excitement starts. It's just about how you're going to fund it. And of course, you can write a check and just fund it that way, but there's many more efficient ways to fund giving into a family foundation. And that's where the fun and the creativity and the strategic philanthropy starts. When you have a tax problem, like Denise said and Lori said, get ahead of that. Your accountant and lawyer will be on top of these things. You can talk to your investment advisors as well about, how do we maximize, minimize the tax that we have at this point in time and maximize the impact we can have, and take those dollars and direct them into your own family foundation. So you deal with your tax problems today, but essentially you and your family can give those dollars away for generations to come, involving your kids, your grandkids. It's one of the most rewarding things that I feel like I can do with a client. Obviously, in the high net worth world, the kind of clients I'm working with, everybody has a lot of money, and with money comes tax burden and tax problems. Instead of complaining about the tax problems, you don't have to make CRA your number one charity. You can pick other charities, starting with your own family foundation and then flowing through that foundation to causes that matter most to you.
Thanks. Denise, can you tell us about a case where you worked with a retiree to use philanthropy to help their family and save taxes?
Absolutely. It's actually something that Mike's going to touch on a little bit later. But I once worked with a retiree whose family, upon just looking at their life insurance needs, no longer needed a said life insurance policy for their financial stability. So we worked with the retiree to name the charity as a beneficiary of the existing policy. Then upon the retiree passing, the charity received the proceeds from the policy, and the retiree's estate essentially received the tax benefits from the donation of the policy at that time. Ordinarily, where the life insurance policy would have likely been subject to probate, it wasn't subject to probate, thereby obviously reducing the retiree's probate fees upon their passing, and ultimately increasing the assets available to the family, from the estate. So in this situation, we took a life insurance policy, which really had no financial need for the family. And given that the family already had philanthropic plans, used the life insurance policy to, give more to that said charity, and obviously increase the family's wealth, at least in the terms of probate fees and the tax savings from the donation that was made. So ultimately, it was a great success. The family was happy to have made a larger donation than they otherwise might not have made, that otherwise would not have made during the retiree's lifetime, and obviously cost them a lot less to do so.
Thanks. Mike, how can registered investments, such as a RRIF, be used to make strategic donations? Would there be a different strategy for securities held in non-registered accounts?
Yeah, another great question, Barb. With RSPs and RRIFs, one of the benefits of them is that you can name a spousal beneficiary, and obviously, upon death of the first spouse, the money just flows to the other spouse tax-free. But what happens if both spouses pass away at the same time, or upon the one spouse, the widow or widower, passes away? You've built up your life savings in this registered plan, and then it all comes out and it's fully taxable. So a $500,000 RRIF or RSP turns into $250,000 or less after tax. $1 million RRIF turns into less than $500,000 after tax. What a shame to see that money just disappear into the tax void. Instead, you can actually donate some or all of the RSP or RRIF to a charity, and it's simple. You just name a charity as a part beneficiary or as a complete beneficiary of that account. And essentially, whatever the portion of the gift is offsets the tax that you pay on that amount. So it allows you to wipe out the tax on that portion of your estate. You'd also name the estate as the beneficiary in your RSP or RRIF, but then it goes in the estate, and you have to name the charities in your will. But that's then subject to probate. So maybe the simpler way is just to name the charity as a beneficiary and deal with it that way. Anyway, if you have questions about this, I think just talking to your financial advisor, most investment advisors, accountants, understand how simple this kind of strategy is. So just reach out to your professional advisors and seek this advice. And if you can't get it from those advisors, obviously, all of us on the committee here are happy to help and chat about it. The second part of your question, Barb, was around for non-registered funds. For me, this is actually one of the most exciting things as an investment advisor. We're often bringing in new clients to our company. And, after the last 13, 14 years in the markets, there's been some pretty big gains. This year doesn't feel as good as maybe the last 10 to 13 years, but there's a lot of big capital gains that people have built up in their portfolios. And many people think to access those funds, you have to sell it, you got to pay the tax, and that's just life. But the reality is, if you were to give securities in kind, it's probably the simplest and single most efficient way to give to a charity or to your own family foundation. Let's say you've got a $500,000 portfolio, and you've got $200,000 in gains in that portfolio because you've been investing for a number of years. If you sell it, you got to pay about $50,000 in tax on that $200,000 gain. If you donate that $500,000 to your own foundation or to a charity that matters to you, you wipe out that $50,000 tax burden because giving securities in kind, there's a provision in the Tax Act that allows you to give securities in kind without paying the capital gains tax. Plus, with that $500,000 gift, you're going to get a $250,000 tax receipt approximately. So what a significant tax advantage that you can get through the gift, but also through the tax savings by not having to pay the tax. And many people have invested in things that have gone up, not just by a reasonable percentage. Some people have made 5 to 10 times their money. So if you want to offset the tax burden of that, speak to your investment advisor and seek out a plan where you can minimize the tax burden, going in with your head, your eyes wide open before you pay the tax, because any kind of security that's up in value, there's a more efficient way to deal with that if you don't want CRA to be your number one charity.
Thanks. Lori, considering current events, why are these strategies more important now than ever before?
Well, that's the question that we're all pondering. Our current events are changing more rapidly than I can ever before recall. I was raised by Depression-era parents who saved every bit of string, and they also planned for the next downturn, as they always warned me, it's for sure coming. Well, my generation has, in my view, had the best life in many generations. We are now, however, in a world that many of us never expected to see and aren't really prepared for. Things are changing rapidly, people are in need, and there are unknown and previously unprecedented illnesses have fallen upon us. If you had told me 3 years ago that a major pandemic was about to hit the world, that I would successfully work from home for 2 years and keep my staff employed, and that I would be considering taking in a Ukrainian refugee family, I would not have believed you. That is just how quickly our world is changing right now. And these current events have raised more and more charitable needs in our communities. In particular, as a result of COVID, and again, I've become involved in Providence and St. Mike's over the years, and I've become familiar with the kind of hard work that our healthcare providers provide to us. Nothing has caused more need than probably the pandemic. And it stretches across everything from food delivery to people. But I do want to focus just a little bit on our healthcare providers. Everything in that chain of healthcare has needed our charitable supports, from our emergency rooms, the ICU, to long-term care. All of these people and these institutions have given their all for our communities in the past couple of years. I know that the St. Mike's and Providence Foundations were critical in supporting these workers and assisting them in doing their jobs for the benefit of us all. And without some of the planned gifts that our foundation had received, we would not have been able to assist these healthcare providers in this challenging time in the way that we ended up doing so. So I want to go back to the idea of, especially of some of the examples that Mike gave, that if you can do some planned giving, you will get the tax benefits. A lot of companies have done very, very well through the pandemic, and I would encourage those owners to take this moment to sort of think about how they can take that wealth and pay it back to the communities that have been supporting them, but to do it smartly. Look at their RRSPs, look at the unused insurance policies. These are the easiest way to do some philanthropic good without taking away from yourself or your family. So our current events, I'm afraid to look at the newspaper each day, but knowing that you can assist with planned giving, I think, goes such a long way in making everyone's life a little bit easier in this challenging time.
Thank you, Lori. Mike, what about a case where someone would like to use, say, a life insurance policy for strategic philanthropy, maybe funded by their donor advised fund or funded by their family foundation?
Great. Asking the investment advisor about insurance. Upfront, I just need to state that I'm not an insurance advisor. I'm an investment advisor. So really, to do this question justice, we should have had a few members from the St. Michael's Hospital Foundation Professional Advisor Task Force insurance advisors that are on the committee with us. And I know we've done sessions with insurance advisors in the past. We'll do them again in the future. So stay tuned for future Create Your Legacy events. But in the meantime, if you have specific questions, there are professionals we can bring to the table to provide you some guidance around that. having said that, in general, it is pretty simple. You can donate a current life insurance policy that you have in place to a charity very simply. If you don't need all of that benefit to go to the family, the kids, the grandkids, you can just change the beneficiary on the insurance in part or all. You could buy a new insurance policy and make the charity the beneficiary. Or you could buy a new insurance policy for a charity, making them the owner and the beneficiary, and just continue to pay the premiums for the charity and get tax receipts for those premiums. So those are some of the easiest ways to create a legacy in that regard, and have a very significant impact on the charity. I do have there are some more innovative strategies. You mentioned how do you deal with a donor advised fund? And I've got a number of clients that have them, and I've got personal experience helping a client with a specific gift. They had a universal permanent life insurance policy, and they were just going to let it lapse. Originally they're going to pass. They just want to pay the premiums anymore, and they're going to pass it on the kids, and the kids didn't want to pay for the premiums, and so they're just going to let it lapse. And all kinds of money has gone into this foundation. There's significant value built into it based on when they bought it, and not stating any kind of expertise around it. I just introduced them to an insurance advisor that I know that understands strategic philanthropy really well. And he provided some specific guidance on, what is this policy worth? Got an independent valuation and said, this is what the policy is worth. And then we were able to successfully donate that policy to that individual's donor advised fund, their family foundation. They got a nice tax receipt for that donation, and now this insurance policy is sitting within their foundation. They still have to pay premiums, but there was some built up cash value in the policy that could pay the premium for years to come, essentially. And then when you look at the tax benefits that they were achieving, that essentially allowed them to pay for the policy for another decade plus in terms of paying those premiums. So further, now that you've got this policy inside your donor advised fund, what are you going to do with it? Well, eventually you're going to pass away, and there's going to be $1 million in this case going to the family foundation. So now you can actually direct that gift to causes that matter. One of the successful beneficiaries of that gift is St. Michael's Hospital Foundation, receiving $500,000, and a variety of other causes are receiving the other half. So that was a really rewarding experience to be able to help a donor have that kind of an impact through their foundation. And it wasn't through me providing direct advice, but it was through the donor bringing up the question and me introducing them to the right people to provide that advice and guidance. That's how the gift got done. And just to sum it all up, that's strategic philanthropy.
Okay, let's go to questions now. If I may, I'd like to start with Lori. Are there any non-financial resources that people could use in the development of their strategic giving plan, like maybe real estate or art?
The top three that come to mind are, as you said, real estate, art, sometimes jewelry, and sometimes your own work. The key to those, the first two, or the first three, art, real estate, and jewelry, is that you really have to have very good appraisals that are going to stand up to CRA's review of them. So you want to make sure that you've got, for real estate, for example, a qualified appraiser that would not normally just rely on letters of opinion from a real estate agent. Probably you'd want to get a full-on appraisal. Same thing with art. Someone with a reputable, with a good reputation and valuation is what you would need. And with respect to any work that you do yourself, helping a community organization, unfortunately, that's not tax deductible. So you don't have to measure that. You can give as much of your own time as you want, but there's no tax credit for that.
Okay, thanks. Mike, is there a limit on how much somebody can save on donations?
Yes, unfortunately there is. You can only offset up to 75% of your net personal taxes payable each year. But anything that you donate over that amount can be carried forward for 5 years. Another interesting point, just in terms of estate planning, upon death, charitable donations can be used to mitigate up to 100% of terminal estate taxes due. Plus, they can be in the year of death. Charitable donations can be carried back to a year prior to death. So that's just something to factor in with estate planning. But generally, it's 75% of income could be offset on an annual basis.
Thanks. Denise, can you give an example of somebody who, let's say, for easy purposes, wanted to donate $1 million? They lived in the province of Ontario, so they're, you know, pretty high, presumably in terms of their tax bracket. How much money are they actually going to get in terms of a tax credit back from the government? Denise?
I just had to unmute myself. So generally speaking, you know, the tax credit is dependent on your overall effective tax rate, as well as obviously which plays into what province you're a resident of. So just generally speaking, you're looking at roughly a 50% tax credit on $1 million. So that would be a tax credit of $500,000.
Okay. And Mike, it seems to me that in-kind securities have a particular advantage from a tax perspective. Can you explain what that's about?
Yeah, so just following on with what Denise was saying, if you had $1 million donation, and let's say there's you're donating securities in kind instead. You know, let's say they've got a $500,000 cost base. You know, they've doubled in value over the last 10 plus years in the markets. Up until recently, the markets have been pretty strong, and so we've seen some big gains in the markets. So if there's $1 million donation with a $500,000 unrealized gain, if you were to donate those shares in kind, you're going to get the same tax credit that Denise talked about, the $500,000, using the 50% average. Plus, on that $500,000 capital gain, you won't pay the tax on the capital gains. So on $500,000, using simple math, only half of the gain is included as a taxable gain. And if you pay that means you're at a 50% tax bracket, you'll pay $125,000 in tax. You get that benefit of not paying that portion of tax. So, you know, one of the best ways to give, in my opinion, is giving securities in kind, and that benefit's even amplified when you do it within a corporation, because that entire capital gain, that $500,000 goes through the CDA account, can be pulled out of the corporation tax free. So, giving securities in kind through a donation through a corporation, best way to give. Second best way to give is giving securities in kind personally.
Okay, and sort of as a complement to that, Denise, can you explain how stock options could be donated?
Yeah, so stock options kind of function, I'll say, almost the exact same manner that Mike just described about donating securities. So as long as you donate the stock options within 30 days of exercising it, and assuming that, you know, the stock options that we're dealing with are, you know, registered securities, you know, basically listed on a stock exchange, what ends up happening is effectively mirroring what happens on a capital gain, meaning that normally you have a taxable benefit on your stock option. And if you're ordinarily entitled to that 50% deduction, so that it's trying to get that capital gain treatment that you would normally get on shares, you get an extra 50% deduction, which, what does that effectively mean? The exercise of the stock option entirely isn't taxable to you. So there's no taxable income to you on exercising your stock option, and then you get that donation credit. So using the same good old $1 million, we're talking about a $500,000, you know, on average tax credit, both on a federal and provincial combined level.
Okay, thanks. Lori, throughout this presentation, we've talked about a really nasty word. Some people call it probate. Is it really that nasty? Can you define it for us and tell us how bad it really is?
Yeah, happy to. I think one of the first conversations I have with clients when they come in and we want to talk about their estate planning, they're always saying, I want to avoid having to pay probate tax or estate administration tax, as it's now called. And it really got its bad reputation about 20 years ago because the provincial government tripled it. Now, having said that they've tripled it, it only went up to approximately 1.5%. So of all of the taxes we as Canadians pay, it really is one of the lowest ones. And so I'm always telling clients, please don't let the probate tail wag the dog, because your planning should be to achieve your ends and not to worry about a 1.5% tax. So I'm generalizing. The tax is actually zero on the first $50,000 of your estate, and then 1.5% thereafter. And so it's not a big number. On $1 million, it's 15,000. It's not a small number, but it's not something that I want people to start changing the ownership of their assets while they're alive and healthy to try and defeat for a death, which we don't know when it will occur. So we do engage in probate planning, and there are techniques that we use, such as multiple wills. And of course, we recommend designating beneficiaries wherever you can, because those can be changed easily. So you can designate them on your RSP, your RRIF, your TFSA, and on insurance policies. And all of those assets will flow outside of your estate, therefore bypassing the probate tax. But again, it's not a big number for most people. And I don't want you to live your life to try and avoid a 1.5% tax.
Good, thank you. Good clarification. Another point of clarification, Denise, can you tell us the difference between a tax credit and a tax deduction?
Absolutely. So a tax credit is effectively a reduction of your taxes payable. A tax deduction is actually a reduction of the income that is subject to tax. So where you get a tax deduction, it's obviously the tax benefit from it is limited to whatever your effective tax rate is for the year. Some instances, like in the case of donations, it's quite possible to get a larger tax benefit from getting the tax credit if, let's say, the tax credit is higher than what your normal effective tax rate would be for tax purposes. It's one of the unique credits that I think gives you that a little advantage in tax savings.
Good, thanks. Mike, you talked a lot about family foundations and forming a family foundation. When is the right time to form a family foundation? And remind us again about how much money you need.
Great. Yeah, thanks, Barb. Yeah, it's a tricky question because it's really whenever you want to set up a family foundation. I guess I'd answer that differently if you're looking to set up a private foundation, because I think then there is some financial constraints. I mean, it's just very expensive to set up a foundation. It's very administrative. You have to be willing to put in the time, the effort, invest the money in doing it. And so, there's no magic number to that, but I'd say for a private foundation, 5 million plus seems to be the number. So, when you have that kind of money and you have the inclination to give and set up a foundation, and you want to be more strategic about your giving, tie the family to the family mission behind it, I think that's the right time. But with donor advised funds, which I talked about earlier, really that's why I said anytime's a good time. It's when you want to set it up, you want to engage the family in family discussions, you want to be more strategic and measured about how you're tracking where you're giving. Setting up a donor advised fund, essentially, it looks and feels exactly the same as having your own family foundation. Only you can do it for as little as $25,000 or even $10,000 in some instances to set it up. So, not everybody has the means to do it, but more people have the means to set up a foundation at the $25,000 level or $10,000. And so I say anytime is a good time. It's really when you want to pull things together, have a family foundation, give today to your foundation for tax purposes, and then give to charities forever and always.
Okay, good. Well, when we're on the question of time, then Denise, maybe you could elaborate about when is the best time to donate over the course of tie it into those liquidity events and tax events that you talked about earlier.
Yeah, so timing is really of the essence when it comes to your donations. Donations, quite honestly, when you have these liquidity events or taxable events or whatnot, whatever the case may be, you're selling your business, you're retiring, you're getting a lump sum pension payment, whatever the case may be, you want to make sure that the donation is either made before or in the year of this taxable event, because to time everything together to be able to claim the donation, you'd have to have claimed it either in the year that the taxable event occurred, so it falls within the same taxation year that you're reporting that taxable event. And the reason why I say before is because you have that 5-year carry forward period. I know we mentioned it a couple of times during our presentation. You have that 5-year carry forward period. So sometimes if you're really proactive and this taxable event is coming in your way, you can start planning ahead of time and say, I want to make the donation now because I've planned for this. I know how much taxes roughly I think this is going to cost me. I want to make this donation. Why sit on it? Why wait? And then that way you have it in the door and it gives you that flexibility to say, okay, I'm going to claim it this year, I'm going to claim it next year, but at least you know what's kind of in place and you're not scrambling at the last minute. But at the very least, make sure you make the donation the same year that you anticipate that taxable event to occur.
Good. Well, we're coming to the end, I think, and I'd just like to ask each of the presenters, is there one more thing that you would like to add that you wanted to give some clarity to, or something that you think is important? If I could start, Lori, with you, anything else?
Yeah, so I obviously approach it from an estate planning perspective. And quite often when you undertake your estate planning, and so you're revisiting your wills and your powers of attorney and who is going to benefit on your death, a part of that can also start to trigger what you're going to do in your lifetime. And it's often a lot nicer to be able to give in your lifetime where you can see the good works that are done by the charity that you're benefiting. Some people like to be recognized for it while they're alive rather than have their name on the wall once they're dead. So not to sound crass, because in my business, we tend to speak quite bluntly about death. But I think it is important when you're doing your estate plan to also think about your own life plan and think about how you can benefit entities and things that you want to see changed during your lifetime as well as after death.
Thanks. That's a great add-on. How about you, Mike?
I'd say one of the big takeaways is before you write a check for a charity, just pause, because so the most common way that people give is by putting a donation on a credit card or writing the check. But a lot of things we talked about today, there's many more efficient ways that you can give that are more tax advantage, like giving securities in kind through a corporation or personally. We talked about life insurance as a way to amplify the kinds of gifts and impact that you can have. So before you just put it on the credit card, maybe talk to the charity that you're giving the funds to, St. Mike's or elsewhere, and pause and just make sure you're giving in the most effective way possible. And the final thing is just the counterpoint to Lori's. Legacy giving is a great way to give. Lots of clients would have life insurance that they don't necessarily need for their need in their entirety for their families. Donating a portion of that to charities is a great way to give, and that's something to think about.
Good. And Denise, any final thoughts?
Yeah, I think I'm going to mirror, obviously what Lori and Mike have said throughout this presentation, I guess myself. Let the philanthropic plans that you have be known to all of your advisors. Having that discussion with your estate planner, having that discussion with your tax advisor, having that discussion with your investment advisor can only help you, making sure that your strategic plans are sound. And like Mike said, reaching out to St. Mike's saying, I want to give, let's figure out the most strategic way to do so will only benefit, obviously, St. Mike's, because hopefully you'll be able to make a larger donation, having made it more strategically. And obviously for yourself, you want to leave a legacy, you want to leave, you want to support these different philanthropic plans. So making sure that, you're making that clear to everybody can only help you and only benefit you.
Terrific. Thanks. Well, I think we've come to the end. Denise, Lori, and Mike, I would like to thank you so much for sharing your strategies and for answering everybody's questions. And thanks to all of you in the audience for attending. Personally, I was inspired by what I heard today. I like bold actions matched by thoughtful strategy. And I hope that what you've learned today inspires you to create your own bold legacy through strategic giving. And I hope human care speaks to you. So feel free to reach out to Sandra Smith at smithsam@smh.ca. You can also find her contact information on the St. Michael's Foundation website. She can answer any questions that you might have about today's event or your legacy giving plans. Thanks once again for joining us, and we look forward to seeing you again very soon.